Gerardo Rodregez, Managing Director and Portfolio Manager of Emerging Markets Group with Blackrock, joins us now. And Gerardo, good morning. Thank you for joining us. Now, trillions of dollars currently is parked in negative yields. While there is a big debate between DM versus EM, what is your stand on how would you analyze the investing environment, and what is your hypothesis for this big optimism in emerging markets?
Yes, absolutely. Emerging markets have gone through a very difficult 3-4 year period in which a macroeconomic adjustment needed to take place. But also, the global environment was a very challenging one. What we're seeing this year, however, is that those factors, those global factors that were constraining the potential performance of emerging economies have actually turned positive. China risk and the risk of a tail event in China, the potential for a rate hike in the Fed and a hawkish Fed. I think now we have more information that the Fed is going to move only gradually. And very importantly, commodity prices in general that have been somewhat of a headwind to EM given the velocity at which they collapse. Now they're stabilizing. They've been actually going up somewhat in terms of oil prices. So all those headwinds that were constraining EM suddenly turn into tailwinds and are supporting the asset class. And that is happening at the same time in which fundamentals of EM have been improving. You may remember the story of a fragile 5 back in 2013. Well, all those countries, their external accounts have improved significantly, and growth is finally starting to pick up in EM. So you combine the global factors with the local factors in EM, and that made ourselves turn more positive on the asset class in general.
Right, Gerardo, so where does India lie in the emerging market pack and its prospects as an investment destination, according to you?
I think that people in the monetary policy circles are getting to the consensus that the scope of monetary policy to continue to drive the policy behavior, I think it's reaching its limits. And because of that, fiscal policy will become a much more important element as part of the policy mix. Now, that is true mainly in the developed world where you have policy rates pretty much at zero or negative in some cases like Europe and Japan. But in the case of EM, actually, you see still many countries that have some space to reduce interest rates further, especially now that inflation has been pretty much under control. The case of India is certainly one of those cases in which there may be additional room going forward to cut interest rates, but also the case of Russia, you're seeing some of that, Indonesia as well. Mexico tightened policy recently, but may have some room to ease if the Fed actually moves at a more gradual pace. So from a policy behavior and a policy stance behavior, recognizing that monetary policy is reaching its limits in the developed world, in the EM world, actually, it may continue to be a supporting factor.
Okay, so what are the specific things that you like about India as a market?
Well, India, I would say, is one of the most attractive investment stories on the equity space over the medium term. It is a country that has a strong leadership, the capacity of the Modi administration to push through relevant reform, And they've done a great job in terms of sort of cleaning up the banking system. It's a work that is already underway. But the framework of monetary policy also in this context enjoys high levels of credibility and has additional capacity for monetary policy easing. So you put all of these things together, and actually India gives you for a nice equity story over the medium term. Now, short term, India is facing some headwinds to growth. Certainly doing reforms implies sacrificing some short-term gains for medium-term improved prospects, and that's very much the case of India. You see the housing sector also improving as sort of the inventory levels have peaked, but still demand there hasn't been picking up to the extent that we were expecting, and also unemployment levels are going up. So again, short term, the case of India is facing some headwinds, but over the medium term is one of the nicest equity stories still at this point.
Now, clearly global investor preference for emerging markets seems to be back. Huge flows are coming in past few weeks. Is this just a mean reversion, or you think the long emerging market trade could be more like a structural trade for a couple of years?
Well, I think that the true story of emerging markets is one of faster GDP growth, higher expected returns of assets in general. But that story somewhat was not able to play out in the past 3 or 4 years because of the global factors that I mentioned before. So what we see now in a more stable global macro environment in which the US dollar appears to be stabilizing, it is in this scenario in which that true and fundamental story of emerging markets is able to play out again. So what I see is rather investors going back to the traditional story of emerging markets. They're rediscovering the asset class after sort of shying away for a long period, and they're doing this also in a context in which other asset classes have become relatively expensive. There's been an important rally in developed market equities for a number of years now, and also interest rates across the board in the developed world have been trending to zero, and you have a number of government bonds actually trading at negative yields. So when you put that in the context of the emerging market opportunity set, actually the asset class looks very attractive, not only from a fixed income, but also from an equity perspective.
Right. Gerardo, some say that the global bond market is pricing in a recession. On the other hand, global equities continue to make new highs. What's this conundrum between the two asset classes?
Well, one way to think about this is that the reasons why yields are negative, more than $14 trillion of developed market government bonds are trading at negative yields. And the reason behind that is these global forces that basically an excess amount of savings are driving interest rates down. And from a policy perspective, we're reaching the limits of monetary policy to basically reach the interest rate that equilibrates savings and investment. So what that means is that we will have a low interest rate environment for many years. And when you turn to emerging markets, both from a local fixed income and a hard currency perspective, yields are actually very attractive. Yields of close to 6% in local currency terms, and say yields between 4.5% in hard currency terms. Those yields you cannot find in many different places. And again, you can invest in EM at those levels in a context in which the global factors have improved, but also the fundamental story of EM has been improving significantly. So because of that, what we think is that what we're seeing right now is an important shift in favor of EM as an asset class that will very likely persist well into 2017.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.